Good morning, everyone. Welcome to this round of the Industry Leader Live interview. I'm absolutely delighted to welcome Joe Stather, who joined CBRE in 2014 and is an Associate Director in the Hotel EMEA Investment Advisory Team. In his career, Joe has gained extensive national and international experience. His in-depth understanding of the commercial and operational functions of a hotel are complemented by his wider knowledge of real estate, financial and capitals markets. Joe, good morning to you.
Morning, James. Thanks for having me.
Well, thanks very much. I really appreciate your time and I know how busy you are at the moment. Joe, tell us a little bit about CBRE, if you can, and your role as Associate Director in the Investment and Advisory Team, so we can get sort of a bit of context and our members can understand actually how you fit into the model and what it is you do.
Sure. So CBRE are a large global real estate advisory firm. We advise across all of the key commercial property types and the operational real estate types as well, which includes hotels and service departments, of course. Where do I fit into that? Well, I sit in the investment advisory team, as you correctly said, and within the broader hotels team, you have a mix of brokers who buy and sell hotels, valuers who of course value hotels, and then us advisor folk that sit kind of somewhere in the middle of the two. We're consultants effectively, and we're working on bespoke projects ranging from feasibility studies through to buy-side due diligence through to strategic advisory. So anything that's not a pure transaction or evaluation generally falls in our remit. And as you correctly said, we operate across the European region. So based in London, a lot of our work is in the UK, but we also extend out into the continent with the support of our local teams.
Thanks, Joe. So we're right in the middle of some challenging times. We implemented a series of webinars and interviews such as this to be able to provide some insight, some understanding for our members and anyone supporting the service department industry. So we're going to ask similar sort of questions to ones we have with other interviewees. But what's your view on the recovery from this pandemic? And what's it going to look like? What characteristics do markets need to have to recover the fastest, in your opinion?
I think in terms of accommodation demand, what we're seeing at the moment is a real bounce in domestic leisure demand, and that's exactly what we expected. So, people have been confined to their homes for a pretty long period of time during lockdown, looking at the same four walls, and of course saving a bit of money as well because they essentially haven't been able to go anywhere and spend any of it. But now lockdown measures have been eased. We're seeing people looking to get out, change of scenery, reconnect with family and friends, and that is providing a good boost for the hospitality sector in general in the UK. Of course, a lot of people have reservations about travelling abroad as well, and there's still a bit of uncertainty around quarantine and what have you. So the staycation market in the UK is doing very well, supported by some pretty good weather as well. And actually, we're seeing that in the hotel space, it's really a bit of a mixed bag, but most of that demand is around kind of rural locations, coastal locations as well. The city centre hotels tend to be a little more quiet, as you might expect. I think people are keen to try and avoid the more densely populated areas. And because hotels, particularly, as I mentioned, in the rural and coastal locations are so busy and in such high demand, we actually expect that summer season to extend and push out into what we would have considered to be more of a shoulder period in the year. I think the true test for hotel and service department performance will come as we get into kind of the October time when leisure demand starts to dry up, the weather takes a turn. Are we going to see a return of corporate demand in any material volume? I think at CBRE, our view is that for corporate demand to return, for international and meetings and group demand to return, we're going to need a widely available treatment for COVID or a vaccine, which probably isn't going to come this side of Christmas. And therefore, we would imagine that that bounce is going to wear off and we'll probably see some lower performance levels or some less buoyant performance levels across the country as we head towards Christmas. I think longer term, there's also a bit of concern around what will happen to that leisure demand in 2021. So, it's no secret that the economic fallout from COVID-19 is going to be material, and already we're hearing of a lot of job losses. Leisure demand, accommodation demand is very much kind of centered around discretionary spend and is linked closely to how confident people feel about their own personal financial situation. So if we do start to see that unemployment figure tick up and people start to rein in their spending a little bit, then again, that could kind of dent the leisure recovery as well, if you like. So I think what we expect overall in terms of a recovery trajectory for the UK is probably an initial bounce, which is what we're seeing at the moment, and then something of a more protracted recovery going forward, at least until we have a bit more clarity around, as I mentioned, a widely available vaccine or treatment for COVID-19.
And it's interesting, isn't it? We have a lot of conversations with our members about demand and corporate demand versus leisure demand at the moment. Staycations are a popular driver. Well, not a popular driver, but they are the only driver that we're really seeing within the accommodation industry, specifically around those rural areas that you mentioned. Most service department operators operate in city centres. There's a dual-edged opportunity here whereby service departments appear to be well positioned to be able to support a restart of the travelling community, because physically service departments, you can isolate oneself, or there's sufficient space within an apartment arena to be able to work and also stay. But conversely, they are in city centres. So how do you think the metrics really for recovery will present themselves in this sort of dilemma, Joe?
I mean, there's no doubt that the demand for city centres is going to be depressed for quite some time, because city centres naturally, what's always been great about kind of city centre located hotels and service departments is that you benefit from the diverse demand characteristics, be it corporate, leisure, international, domestic, and that's actually insulated a lot of properties in these locations through previous downturns. It just kind of turns out that what we're seeing at the moment is it kind of totally flips that argument on its head. So demand will remain low for city locations, I think, for some time. However, to all of the points that you've just mentioned, I think service departments, as far as an accommodation option go, really are in favour at the moment. And there will still be a degree of travel demand for city centres. Certain people just can't kind of function without going to a city centre, whether it's for visiting certain people or whether it's for their line of work. And I think service departments are really well positioned to capture the lion's share of that. And actually, we've looked at some performance statistics for London, just as a case example. And you look at how the rate gap has widened between service departments and traditional hotels, it would suggest that people certainly are willing to pay a premium to stay in a service department, because they can more effectively social distance, keep themselves to themselves. There's more room in the apartment unit itself if they're spending a longer period of time there. I mean, over the last few years, we've seen hotel rooms get smaller and smaller, which has been great, sometimes for intensifying the revenue generation of a particular kind of piece of real estate. But actually now, who wants to be stuck in a 19 square meter room? I think if you're having to spend an extended period of time in there, that's not really appealing. And that's where service departments are really coming into their own.
It's really interesting you say you're noticing the gap sort of spread between service department daily rates and hotels. But I mean, the question on everyone's lips is, are we past the worst of this?
I mean, that's difficult, isn't it? I think there's so many different factors that kind of come into play here around potential for a second wave, localized lockdowns, and it's really so location specific. One of the things that we have seen really impacting the sector is this squeeze on working capital, particularly for owners and operators which are maybe signed up to lease agreements, because whilst hotels have been closed, you inevitably have fixed costs which continue to drag on profitability, whether your hotel is open and trading and generating revenue or not. And as we move forward, if we don't see a material uptick in performance and occupancy remains relatively low, we're still going to see hotels and service departments, albeit open and trading, but not breaking even, which means that pressure on working capital is going to become even more acute going forward, even though we're starting to physically see more properties open their doors and welcome guests. So it really depends on, at what point can hotels and service departments start to actually turn a profit and the tide turns the other way. Because we've also got things to consider, like the furlough scheme, which at the moment, government supports really shielded the hospitality sector against a lot of the impact of COVID-19. But as we start to see a lot of those support measures kind of reined back in, if you like, and I think we'll start to see a more true impact on the sector. So are we past the worst? I think from a demand point of view, maybe we are, but I think there are other challenges through the P&L, and certainly for owners and those operators which are committed to lease agreements that might be coming down the track.
And in terms of looking forward, we talk a lot about distressed sales. Explain to us what that is and how realistic a prospect they are looking ahead.
So distressed sales are basically where the owner of an asset or assets basically has no other option but to sell their property or properties in order to recoup losses and to pay off their debtors or creditors or whatever the case may be. In terms of the prospect of distressed sales, again, it comes back to the trajectory of recovery, I think, and how acute that pressure becomes on working capital. There is no doubt that the smaller owners and the less diversified owners with limited access to additional credit lines, for example, they're really feeling the pinch already. And actually, some of the properties that we've already seen come onto the market are kind of those smaller properties, if you like. It's the smaller lot sizes where the owners just don't have the deep pockets. I think if you look at some of the kind of larger properties that have so far come onto the market, I think some of the portfolios and assets that we have seen coming onto the market were already in a pretty bad place prior to COVID. But yeah, as we get towards Q4, I think there is a chance that we will see some distress coming through in terms of distressed sales and forced sales.
And what about the supply pipeline then? Where are you seeing that developing, and what's most acute out of that?
Yeah, now this is an area that gives us a little bit of cause for concern, and it's really kind of born out of how well the accommodation sectors were performing in the run up to COVID. I think in 2018 and 2019 we were seeing really strong performance even in the UK regions, whereby hospitality markets were outperforming, or as a whole, the regional UK market was outperforming what we saw in a lot of capital cities across the European continent. We were really kind of riding on a high wave of demand and strong performance, but that spurred a lot of development activity because naturally investors and developers wanted to kind of latch onto that trend and drive some strong returns. So we saw a real uptick in the appetite to develop new hotels in the UK. And it just so happens that we've had this unprecedented event, which has caused performance to fall off a cliff. But a lot of those development projects are now already committed to, have broken ground and are in construction. And we fully expect them to still be completed, albeit with a bit of a delay in some circumstances. I mean, in terms of the cities where we expect the largest kind of increase in accommodation relative to existing are cities like Glasgow, Manchester, Cambridge is another, Bristol, and those markets are all expecting to see an increase based on existing supply of in excess of 15%. So that's a lot of new bedroom stock coming online. And those are the markets which generally rely quite heavily on international accommodation demand, which is probably going to be kind of the last area of demand that's going to recover back to where it was in 2019. So we do have some concerns that some of those kind of pipeline records that we're monitoring at the moment are going to have a material kind of impact on the recovery trajectory of those hotel markets, and not for the better, unfortunately.
And naturally that will have an impact on the value and the pricing across the market. What are your thoughts on how that will shape up over the next few months and years then?
Well, before I jump into that, I would just say kind of on the previous point that as a result of some of this new supply coming on board and the pressures that we are seeing, it is likely that we will see some stock fall out of the market and potentially be repurposed. And we're looking at opportunities in some markets for certain assets to be converted to things like healthcare or student accommodation. And you do have the benefit in the beds sectors, if you like, which kind of encompasses hotels, service departments, residential, other forms of residential, healthcare and what have you, that the physical nature of the asset is always quite similar. So there is a bit of scope for alternative use. Just in terms of where do we think the impact is going to be in terms of kind of values going forward and pricing. Well, I mean, we're talking a lot at the moment around kind of the big bid-ask spread, because we're seeing a real hiatus in transaction activity at the moment. And that's caused by the fact that owners are doing their best to hold on to their assets and reluctant to sell at a heady discount, whereas you've got a lot of investors, particularly the opportunistic funds, the private equity funds, that are out there looking for big discounts and to buy good hotel product in strong locations, as I say, at a pretty big discount. So at the moment, you've got this kind of stalemate, if you like, of owners not wanting to budge and investors not wanting to pay over the odds. I think as we go forward, that working capital issue I mentioned will become more acute for some owners, who will then start to maybe alter the expectations in terms of what they could receive for their asset. And I think similarly, as the trajectory of recovery becomes more clear towards the back end of the year, then investors will find it easier to underwrite deals as well. And we'll probably have a narrowing of that bid-ask spread, which will result in more deal activity as we head through towards Q4. I think in terms of the impact on values, again, it's very, very kind of specific to the particular kind of location and asset, as you can imagine. But there's no doubt that sentiment would suggest that, you know, whilst we haven't seen much transactional activity, sentiment would certainly suggest that yields in the hotel and service department space are moving out. And, you know, some of that comes down to the fact that there's not the debt availability that we saw back in 2019, when kind of the capital markets were awash with competitively priced debt, for example. And that's certainly going to have an impact on asset pricing as we move forward.
Interesting. My goodness. And I think, you know, certainly my involvement within the service department industry over the last 8 years, we've seen some incredible innovation, entrepreneurial spirit, an ability to move and flex and change very quickly. So what sort of creative responses are you seeing, or what your anticipation is for the industry stakeholders as we progress through this year and into next year?
I love that you mentioned the adaptive capacity of the sector and the industry more generally, because that's really what's helped us out of sticky situations in the past, and no doubt will help us out of this one as well. I think the travel industry in general has been, you know, great historically at adapting to new trends, but yeah, of course, this is probably the hardest challenge that the industry has ever faced. I mean, you know, what creative responses are we seeing? Well, you know, cleaning is an obvious one, and you see that in the press a lot about kind of new protocols as far as room cleaning is concerned. But I think, you know, let's be fair, rooms weren't dirty to begin with. So yes, there might be some kind of increased or new chemicals that are being used to clean rooms, and some slightly new SOPs in properties. But I don't think the kind of room cleaning is going to be the key differentiator between before and post-COVID. I mean, we're also seeing measures in the press again around kind of contactless check-in and new technologies being implemented. But I think you've got to ask the question as to who foots the bill there, because, you know, I've touched on it so many times in this discussion, but the pressure on working capital is just massive at the moment. And implementing measures like contactless check-in and being able to kind of choose your room on your phone and have no contact with people behind the desk and what have you, you know, that's really expensive technology to implement. And when people don't really have that much cash kind of swilling around in their coffers, it's very difficult to get them to part with it on things such as that. You know, their focus at the moment, I think, is primarily keeping their staff and their guests safe. I mean, yeah, some of the other creative responses, I think, are in terms of how demand is captured. And there's been a really interesting response from some of the international brands who I think historically have always marketed themselves, and certainly to owners in the service department and the hotel space, as being the guys that can, you know, pull in the international demand and the cross-border demand and really appeal to the international corporate traveler with their big points system and all of that. Whereas actually what we're seeing is a real U-turn. And now they're kind of working with owners on a more local basis to think about what's the demand opportunity more within our own region, knowing that people aren't going to be making super long journeys and that we are seeing this big increase in staycation demand. So how can they capture on that, as opposed to appealing to people on kind of all four corners of the globe, which is a really interesting kind of really interesting move in the industry, I think, and one to keep an eye on.
And it is, isn't it? I mean, it's crystal ball stuff. How on earth are we going to predict what's going to happen over the next few months and years? And I think, what we're trying to do from certainly what we're seeing from an optimistic perspective is organizations throwing their energy at strategic discussions about what it looks like when we do, if we do ever come out of this. And I mean, from your perspective, from CBRE's perspective, what gives you guys the greatest optimism looking forward then?
I think our optimism, and this is echoed by a lot of the kind of longer term investors that we work with, so kind of the institutional investors that take naturally a through the cycle view, is that if you look back at the travel industry, and I kind of mentioned this earlier, but the travel industry has always bounced back. We've been through recessions. Yes, this is likely to be the deepest that we've ever seen, but we've been through industry downturns, and the sector has always bounced back. And I think more so than ever, in the last 10 years, we've really seen a material increase in the demand for experiences and for travel. I mean, the fact that people, even now with all of the measures that are in place and the concerns that are all too apparent, people are still jumping on planes and going on holiday. People are so keen to travel and get out there and see new places. And I think that will endure long beyond COVID-19 and will continue to drive kind of growth in our sectors as we move forward. So yeah, let's look forward to those brighter days, I think.
Well, I absolutely. And I think, what we're seeing certainly is that there is more travel, there is more frustration at being locked down. I think that's going to drive demand. And we're certainly seeing that from our members' perspective that, things are beginning to pick up. So let's try and hold on to that positivity after the end of what has been a really challenging period, Joe. So
Absolutely.
Thank you so much for your time. I can't thank you enough. An absolute inspiration talking to you, Joe. Really, you're a real asset to CBRE, and appreciate all the time you've given us today. It's been really insightful. Thank you.
Oh, thank you, James, and to the ASAP as well, and keep up the great work that you do for your members.
Brilliant. Take care, Joe. Thanks again.
Thank you.